we've seen lower rates and all these tech stocks rally. Is that how you perceive it?
Yes, yes, in a way. Typically, when we know the Fed's going to pause, the market looks over whatever's going to happen tomorrow, and it may be 25 basis points. So I think we're there. I think the banking crisis has put us there. But I do think that this okay, the Fed is or the FDIC is here to save the day. I think that's too easy an answer right now. And I don't think that the Fed or many of the people I hear discussing this really do understand how harmful this is to the underlying economy. And our strategy tends to do pretty well when interest rates are coming down and when
Hmm.
the cyclicals are weak. And I must give you and your team credit because you're raising this question more as people are saying, no, there are two things going on here. One's financial stability, one is inflation. Well, they are related. And if we're right, and deflation is the bigger risk here, and we obviously our conviction has increased. We've been saying this ever since last spring when credit default swaps started going up on the banks. We were saying, ooh, there's a deflationary risk. And then we had the inverted yield curve. And then, my letter to the Fed, which basically was asking the question,
Hmm.
how can you be unanimous with these 75 basis point increases when these financial indicators are yellow at best, and really we thought flashing red.
Well, you might get your wish. I mean, the Fed expected to raise 25 basis points tomorrow and then, according to the market, be done and start cutting, which I know would be helpful for you. But my question, Cathie, is the result of all of these issues and the lower rates is that the market now thinks we're headed for a deeper recession and starting to price
Mhm.
in that, no longer the soft landing camp. And in that kind of period, wouldn't you want especially technology stocks with better balance sheets that are more higher quality than the sort of newly profitable or unprofitable and riskier tech stocks that you're in?
Well, something very interesting has happened over the last year, actually, after over the last 2 years. So, our strategy peaked out in February of 21. A lot of our companies had done secondaries when they were booming. The stocks were booming in 2020, early 21. And today, what we find now that they have the cash and they've been cutting costs, streamlining, our ARKK fund has a weighted on a weighted basis a runway of roughly 6 to 7 years of cash, and our ARKG fund, which is where we would have the most questions because they are very early stage, they have, and it's because the markets demanded it, been cutting costs, raising cash, and they have 4 years of runway. We actually think we're in very good shape, and that interest rates coming down is going to be another booster. Again, it's the valuation hit of the last year that has been so severe to our strategy, February of 21 to today. And that was all related to the Fed jacking up interest rates 19-fold in less than a year. Unprecedented. We think it's like an earthquake, not just for our strategy, actually. We now think the earthquake is rolling off of our strategy and into other strategies. And those that are cyclical, we think are going to face some quite severe challenges during the next, I'm going to say, 6 to 9 months.
Well, if that's the case and cyclical is under pressure because of the economy, because of the Fed, I mean, why have you been adding Block, for instance, the last few days? I mean, really amassing a pretty sizable position in this company, which is so tied to consumer discretionary spending.
Yes, what we're seeing with Block, Square, Cash App, we're seeing two things. It is reducing the cost of financial services, and so more people are flocking to it. And in fact, it's developing a closed loop ecosystem, and we believe could be one of the big winners in the digital wallet space, where it won't even have to interact. Where their clients won't have to interact with banks. Cash App and Square will take care of that and really become the financial services company. So, and what that does is takes The number of toll takers, if you have a closed loop ecosystem, the number of toll takers in a transaction between a merchant and a consumer dropped from 9 to 3. And you can find that analysis in our Big Ideas 2023 on digital wallets.
Cathie, it's David. I am curious as well to get your take on AI. There's been a great deal of enthusiasm generally seen in a number of different stocks with the obviously introduction of ChatGPT 3, 3.5, 4. How does this, in your opinion, sort of sort itself out? And where is, again, are you putting your money to sort of support this thesis that it is a new world we're entering?
Well, I think because of OpenAI and ChatGPT, we think the good news there is it has captured the imagination of consumers and investors very quickly. So that's exciting. We've been talking about AI and all of the incredible breakthroughs we've seen over the last 3 years. But finally, ChatGPT has raised its visibility. So the natural beneficiaries, and many people own these stocks, are Microsoft and NVIDIA. But, in many ways, compared to our stocks, we don't own those two in our flagship. Those are the very obvious plays, and investors are paying for them from a valuation point of view. We think the overlooked beneficiaries are those that have proprietary data. And if you take a look at our portfolios, you will see companies that have proprietary data that will be activated by artificial intelligence. If you look at ChatGPT, that kind of AI product or service, I should say, is going to be commoditized in a way, and the real beneficiaries are going to be companies who have AI expertise, domain expertise, and critically, a large body of data. And we think Tesla, the largest position in ARKK and ARKQ, and we even own it in ARKW because it's an AI company, it is probably one of the most important AI beneficiaries in the form of autonomous taxi platforms, ultimately, which are powered by AI.
Got to ask you about Tesla, Cathie. I know you're one of your favorites and your top holding still, always a battleground. The latest concern from investors is about margins. So they've been taking these price cuts, which we debated last time, and even if that's catalyzing demand, at what cost? Is that a reason for concern?
Well, I think Tesla has, and Elon Musk in particular, has said that he will pass along any cost declines that Tesla is enjoying. And I think that's what's going on right now. And I think he's in a position to drive prices down much more quickly than most other manufacturers, save for some in China. And I think there's deflation in auto prices taking place in China. I think Tesla led that and BYD followed. And so there's a deflationary tug there, which is actually going to accelerate the shift from gas-powered vehicles to electric vehicles, which is something that Tesla wants. So we think the mistaken assumption here is that Tesla has to cut prices because of competition. Tesla, we think, can drive prices down because its costs are moving down, particularly battery and drivetrain costs, faster than most other manufacturers.
Cathie, it's David again. I get this question from a number of your holders in the flagship fund, which is simply how expensive it is. I think your ratio is double the average ETF, and your performance, when we look at it, at least over the last couple of years, is in the bottom 5%. How do you justify what the FT talked about as much as $300 million in fees going to you, despite what has not been good performance?
Well, we have a 5-year investment time horizon, and believe me, the last 2 years, this earthquake caused by interest rates put a dagger into our strategy. We believe that we're on the other side of that now. And that valuation that you're talking about really is a very short-term way of looking at our portfolios and not the correct way. We are the closest you'll find to a venture capital fund in the public equity markets, except, as I just mentioned to you, our companies have huge cash positions, right? And so our assumption, our working assumption is that our valuations, you say they're twice the average now, we assume that they're going down to the market in 5 years. And we are looking and we require a minimum 15% compound annual rate of return over the next 5 years. And we think that the stocks in our portfolios, based on our research could be wrong, but I think it's been better than most when you talk about electric vehicles, you talk about AI, you talk about sequencing technologies, you talk about blockchain technologies. This is where the world is going, and it is going to disintermediate and disturb and disrupt the traditional world order. And so we think our companies and our stocks are on the right side of change. They assume massive multiple compression. And we also assume that our companies will enjoy what we're calling exponential and super exponential growth. Many people don't understand what those concepts are because we have been living in a linear growth world for so long. And so if we're right, you look at our electric vehicle forecast, for example, we believe that electric vehicle sales will move from 7.7 million units last year to 60 million in 2027. That's exponential growth. What does linear growth look like? And this is what most, well, the consensus is. They say 20 million. If we're right, there's a huge gap there that our stocks are going to enjoy filling.
And if I hear you correctly, then you're saying your expense ratio obviously will decline as your performance gets better.
No, I thought you meant valuation in terms of the valuation of the portfolios.
No, I was talking about your actual expenses, the fees that you charge your investors.
Well, you get what you pay for, right? So you're talking about ETFs that are more passive or self-indexed and automated, frankly. Ours are active, fully active, and our expense ratio, if you compare our expense ratio to mutual funds, all-in expenses, we believe we're half the cost of mutual funds, and the end investor knows it because many companies now, it's taken a long time, and these are truly active managers, are starting to move towards the ETF for wrapper. Why? For 4 reasons. Liquidity, more liquidity. You can trade them all day long. More tax efficiency by far. We have built up in ARKK more than $2 billion of tax losses for obvious reasons that we can apply against future gains. They are more cost effective, which I just mentioned a while ago. And there's one more that escapes my mind. But 4 reasons that the ETF wrapper is a better wrapper than mutual funds, although mutual funds are much better for 401k plans and others just because of the way the technology is set up. We hope that changes as well.
Oh, no, we are showing a 5-year transparency. We're showing a 5-year chart, Cathie, and the S&P is up more than 40%, and your ETF is down over that period. I know that's the way you measure it, but it has been significant underperformance even in that time period.
Yes, and we've never had a period where interest rates have gone up 19-fold, which would, again, put a dagger in a strategy like ours relative to all others. If we're on the other side of that, and we were the prime victim, and I don't mean personally, I just mean interest rates would hurt a long-duration strategy like ours, just like it killed long-term bonds last year, which performed the worst they have in decades and decades, if not hundreds of years. We should be the prime beneficiary. So I think you're looking backwards at something that did happen, We could not believe that the Fed was taking interest rates up so much. And let me just give you a sense of what kind of heart attack this is, or earthquake. That's a better analogy. If you look at what happened in the last year to interest rates, up 19-fold, a lot of people, and the inverted yield curve that started last July flashing red, the inverted yield curve, the week before the crisis, the bank crisis, the inverted yield curve was more than 100 basis points. Hadn't seen that since 1981. Everybody, the light bulb went on. And everybody said, okay, well, it's because they're being as tough as Chairman Volcker. No, they were being 4 times tougher than Chairman Volcker. And the way you measure that is 100 basis points, or 1% on a 4% long-term bond yield, is 4 times more than 1% on a 15%. So that would be 1/4 is 25, and 1/15 is somewhere in the 6 to 7 range. So that's if you use the Richter scale, yes, Volcker had a Richter scale of 6.5 or whatever. And I know what that is. I'm from Southern California. I've been in a 6.5 Richter scale. This was 24, and we're seeing the ramifications now, and they're deflationary.
Got it. Well, I don't know. I mean, I know you've been saying that for a long time. Still expecting Powell to move tomorrow, though it's a tougher call than usual. Cathie Wood, thank you very much for sharing your thoughts, of course, and your performance and talking through some of the names. We always appreciate the time.
Truth will win out. Thank you. Innovation solves problems.
Cathie Wood with the marketing pitch at the end.
There you go. All right, still ahead. Charles Schwab's Liz Ann Saunders arguing, quote, this isn't 2008 again. Find out why in just a moment. Squawk in the Streets back right after this.